Meta has spent nearly $70 billion on AI this year alone. The stock is down 20% from its highs, and the market is genuinely split. Is this Zuckerberg's biggest mistake, or the smartest bet in tech right now? I already own Meta stock, so I've got real money riding on getting this right. Today, I'm doing a full breakdown. The business model, the CapEx fears, the fundamentals, and what I think the stock is actually worth. Let's get into it. First, to truly understand Meta's business, you have to stop thinking of it as a social media company. Yes, they have their family of apps, Facebook, Instagram, WhatsApp, and Threads, but at its core, Meta is an advertising business that monetizes engagement on those apps. And despite having 3.58 billion daily users across those apps, still growing at over 6% per year, this isn't the only number they prioritize. Perhaps the more important measure of Meta's success is their ARPU, or average revenue per user, which hit a 12-month high of $57.03 last quarter, up almost 15% from this time last year. And that ARPU number is the main lever the company has to grow its overall revenue. Looking at Meta's total revenue, it recently hit a record $200.97 billion, a result of the combined daily user and average revenue per user growth. We also have to acknowledge their Reality Labs segment. This is their augmented reality Meta glasses business. I call it a business, but it's currently losing billions of dollars annually to develop the technology. But with fundamentals like these, how comes the market is currently punishing the stock? The answer has something to do with CapEx. CapEx, also known as capital expenditures, are investments to acquire, upgrade, or maintain physical, long-term assets such as property, buildings, machinery, or in Meta's case, technology. If we look at this chart, it'll explain why the market is spooked by Meta's CapEx. The red bars are Meta's CapEx over the past 5 years. The reason the bars are in red is because this is the money coming out of the business. Then the blue bars represent Meta's operating cash flow over the past 5 years. This is the money Meta has produced from its core advertising business. And then in green, we have Meta's free cash flow. This is the money left over after subtracting CapEx from operating cash flow, hence why it's in green. It's the good stuff. The problem that the market currently sees is that whilst operating cash flow is growing, CapEx is growing significantly faster. And while the blue bar representing Meta's core business struggles to match the growth of the red bar representing money coming out of the business, you're left with declining free cash flows. This essentially signals to the market that the business is becoming worth less over time because companies are usually valued using a discounted cash flow model. These models lean heavily on a company's ability to produce growing free cash flow. If a company's free cash flow is declining, like in the case of Meta, valuing the business becomes less predictable. And this fear is compounded by the fact that Meta stated in their recent earnings call that they expect CapEx for 2026 of between $115 and $135 billion, which reflects a significant step up in spending tied to Meta Superintelligence Labs and core business infrastructure. However, there's some important context that focusing on capital expenditures ignores. These capital expenditures are being spent on AI-optimized data centers and all of the GPUs and networking equipment that data centers need to operate. Meta is basically investing in its own computing capacity and capability. This decreases its reliance on external cloud computing providers like Alphabet and Amazon, who Meta directly competes with for advertising dollars. Meta is even investing in custom chips to reduce their reliance on Nvidia and AMD's GPUs. Not only will custom chips be more suited to solving the problems Meta requires, but they'll also be cheaper in the long run. Luckily, Meta's core business is so strong and profitable that it can afford to make these investments. The business produced $36.2 billion in operating cash flow and $14.8 billion in free cash flow last quarter alone. And their operating margin remains well above the 40% mark. So it's not like they're going to run out of money anytime soon. And if you think about it, they kind of have to make these investments. Because if they don't, not only will their ad targeting become weaker than their competitors, like Alphabet and Amazon, but their entire business would be reliant on their cloud computing services as well. After the Apple iOS changes that cost Meta $10 billion of revenue back in 2022, they can't afford to surrender their computing supply to competitors as well. So although these investments are testing the limits of what's possible, Meta's revenue and free cash flow are sustainably supporting them. And from a long-term investment perspective, the longevity of the business is probably the most important factor. If these investments are necessary to extend the life of the business, which I believe they are, then it has to be done. Despite the doom and gloom surrounding Meta's AI investments, there's already signs that its CapEx is paying off. In Q4, Family of Apps ad revenue was $58.1 billion, up 24% year over year. Ad impressions grew 18%, and average price per ad rose 6%, driven by improved ad performance and advertiser demand. So not only did ad performance improve, but that success drove higher demand from advertisers. A new runtime model across Instagram feeds, stories, and reels delivered a 3% increase in conversion rates in Q4. A runtime model is the AI model that runs in real time to decide which ad to show, which user to show it to, and where to show it within the app, and also at what moment to show it. It's the live model that powers Meta's ad auction and ranking system. That 3% increase in conversion rates means for the same advertisers, same budgets, and same creatives, users converted 3% more often because the AI got better at choosing the right ad for the right person. This kind of incremental increase is incredibly important because it improves the advertiser's return on ad spend. Advertisers will naturally allocate more of their marketing spend to the place where they can get the highest return. The higher Meta's conversion rates, the more likely they are to receive more money from advertisers. It's mutually beneficial because the higher return for advertisers can simply be reinvested into more ads via Meta's apps. And that 3% increase came from just one new model rollout. We should see even better results from the $115 to $135 billion in 2026 CapEx. And that's the most crucial point. The CapEx investments made by Meta are front-loaded. It's highly unlikely that CapEx will grow at the current rate for more than a few years. Once it slows down, Meta will be left with the benefits of those investments, which could help revenue continue to compound at above 20% over the next 5 to 10 years. Now for the moment you've been waiting for. We're going to look at Meta's stock's valuation, and then we'll use Qualtrics' DCF calculator to estimate the return we could expect from Meta stock over the next 5 years. Meta's currently trading at a 21 forward PE ratio, which is lower than the 27 forward PE ratio that Alphabet currently trades at, and significantly lower than Amazon's 29 forward PE ratio. If we look at Meta's historic price to earnings ratio, you'll see over the past 5 years that it hasn't really moved. Of course, there's been periods of volatility, especially in 2022, but it mostly trades at around a 25 price to earnings ratio. I would usually focus on a company's free cash flow yield to value it, but due to Meta's current investment cycle, it's quite difficult to estimate free cash flow accurately. So using earnings will estimate the potential return of Meta stock over the next 5 years. And as stated, the stock usually trades at a 25 PE ratio, and I don't see that changing really, unless they massively reaccelerate revenue to around like 30% annually. That would be a pleasant surprise. For now, we'll plug in 25. And then in terms of EPS growth, if we look at the past 5 years, Meta grew EPS at above 18% per year. But that's been negatively impacted by the recent decline in EPS, which isn't as straightforward as the chart suggests. The decline had nothing to do with weaker demand, but more with increasing operating expenses from Meta's AI investments. There's also increased depreciation expenses from older GPUs having to be replaced by new ones. It seems even EPS isn't safe from Meta's CapEx investment boom. However, I believe Meta's AI investments will produce significant returns over the next 5 to 10 years. Maybe the investment cycle will run longer than expected, but in that case, I expect Meta's management team to see even greater returns than first expected. So I'm willing to assume annual EPS growth for Meta over the next 5 years of 20%, meaning that from today's price of $630 per share, investors can expect an annualized return of over 18%, more than doubling to just under $1,500 per share in 2031. So my verdict is yes, Meta stock is a buy today. It clears my 15% hurdle for desired return, although I'm not personally buying the stock right now because I've already got over $3,000 invested in the stock.